Let me ask you something. When was the last time you heard anyone talk about aluminum? Not gold, not silver, not Bitcoin? Aluminum. What about copper? What about nickel? I'm guessing the answer is almost never. Because these metals aren't sexy. They don't make headlines. They don't trend on social media. Nobody makes viral videos about the aluminum market. And yet, while everyone has been laser focused on gold breaking records and silver going parabolic, something else has been happening in the shadows. Something that might actually tell you more about what's really going on in the global economy than the precious metals ever could. Copper just hit record highs. Aluminum is trading at levels we haven't seen since 2022. Nickel has surged almost 28% in a matter of months. And here's the part that should make you lean in closer. The fundamentals don't fully justify these moves. That's not me saying it. That's the analysts. That's the people who study supply and demand for a living. They're looking at these rallies and scratching their heads because the numbers don't add up. So if it's not fundamentals driving these moves, what is it? That's what we're going to unpack today. Because I think the industrial metals are telling us something important, something that gets lost in all the noise about gold and silver. And if you understand what that message is, you'll be way ahead of most people who are only watching the obvious trades. Now let me start by giving you the lay of the land. Gold just hit a fresh record high of $5,400.91 per ounce. That's up 39% since the October low. Incredible move. Everyone's talking about it. Rightfully so. Silver has been even more impressive. From a low of 45.51 in late October to a high of 117.41 just this week. That's a gain of 158% in about 3 months. Absolutely explosive. But while you were watching gold and silver, here's what else happened. Copper gained 24%, from a low of $10,580 per ton in early November to over $13,000 per ton this week. That's not far from the all-time record of $13,407 hit just a couple weeks ago. Aluminum jumped 16%, from $2,805 per ton to over $3,250. That's the highest close since April 2022. Nickel rallied 27.5%, from $14,330 per ton to over $18,200, close to the 21-month high set late last month. These are massive moves. These are the kinds of gains that would make headlines if anyone was paying attention. But because copper and aluminum and nickel aren't as glamorous as gold and silver, they fly under the radar. And that's exactly why you should be paying attention. Because the industrial metals don't lie. They're not driven by fear or speculation alone. They're tied to real economic activity. Factories, construction, manufacturing, infrastructure. When industrial metals move, it usually means something is happening in the real world. So what's happening? Let me break it down for you. There are really two forces at work here, and understanding both of them is crucial to understanding what's going on in metals right now. The first force is China. I know. Everything always comes back to China. But there's a reason for that. China is the single largest consumer of industrial metals on the planet. When China buys, prices go up. When China sells, prices go down. It's that simple. And right now, China is doing something interesting. They're buying more and exporting less. Let's start with copper. China has been importing more copper, especially in the second half of last year. December arrivals hit 437,000 tons, up over 2% from the prior month. That steady demand from the world's biggest consumer has been putting upward pressure on prices. But there's another wrinkle to the copper story that's worth understanding. Much of copper's rally was built around the flow of metal into the United States. Why? Because traders were afraid that Trump would impose import tariffs on copper. So they front-ran the tariffs by shipping as much copper into the U.S. as possible before any duties kicked in. When tariffs were eventually imposed only on some copper products, the panic eased a bit. But the price had already moved, and it stayed elevated because the underlying demand from China hasn't gone away. Now let's talk about aluminum. China is the world's biggest producer of aluminum. And last year, they shipped less of it to the rest of the world. Exports of unwrought aluminum and products dropped 8% to just over 6 million tons. When the biggest producer ships less, there's less supply available globally. And less supply with steady demand means higher prices. That's Econ 101. Aluminum prices have been on a rising trend since April. And that loss of Chinese supply is a big part of the reason why. Now here's where it gets really interesting. Silver. You might be wondering what silver has to do with industrial metals. But silver is actually both. It's a precious metal and an industrial metal. And China's moves on silver could have massive implications for the global market. China just implemented new licensing rules for silver exports. Only 44 companies are now allowed to export silver this year and next. Let me repeat that. Only 44 companies in all of China can export silver. Now, restrictions on actual shipments haven't emerged yet, China shipped about 5,100 metric tons of silver last year, which was actually the most since 2008. So the physical exports haven't dropped yet. But here's the concern. Silver is a critical component in solar panels, and China is going all in on solar. They're building solar capacity at a staggering rate, and every solar panel needs silver. So there's growing concern that China will prioritize domestic consumption, that they'll keep the silver at home to feed their own solar industry. And if that happens, there will be less silver available for the rest of the world. That's partly why silver has been so explosive. The supply side of the equation is getting tighter just as demand is increasing. All right, so that's the China factor. Increased imports, reduced exports, tighter licensing, real supply side changes that are affecting prices. But here's the thing. China alone doesn't explain the magnitude of these moves, because here's what the analysts are telling us. Most of them see copper and aluminum as fairly well-balanced markets from a supply and demand perspective in 2026. Nickel is actually likely to remain in oversupply. So if supply and demand are roughly balanced, why are prices surging? That brings us to the second force, speculation. And more specifically, the same speculative dynamics that are driving gold and silver. Think about what's happening in the world right now. You've got massive uncertainty about US policy under Trump, tariffs, trade wars, unpredictable announcements that move markets overnight. Nobody knows what's coming next. You've got a weakening US dollar. The dollar has been sliding, and when the dollar drops, commodities priced in dollars tend to rise. That's a mechanical relationship. You've got concerns about government debt, about inflation, about the long-term value of paper money, and you've got investors who are increasingly looking for real assets, things you can touch, things that can't be printed, things that hold value when everything else feels uncertain. Gold and silver are the obvious beneficiaries of that sentiment, but they're not the only ones. Copper is a real asset. Aluminum is a real asset. Nickel is a real asset. When money flows into real assets, it doesn't just go to gold and silver, it goes to the whole complex. Industrial metals catch a bid because they're part of the same trade. And that's exactly what we're seeing. Industrial metals are riding the coattails of the precious metals rally. Now, I want to be careful here because I don't want you to think I'm dismissing these moves. The gains are real. The money flowing into these markets is real, and there are legitimate fundamental reasons for some of the strength. But there's also a speculative component that you need to understand, because speculation can drive prices higher than fundamentals alone would justify, and speculation can reverse faster than fundamentals. If you're looking at copper or aluminum or nickel purely through a fundamental lens, the current prices might not make sense. But if you understand that there's a speculative premium built in, then the picture becomes clearer. The question is how long that speculative premium lasts and what happens when it unwinds. Let me share something with you that I've been thinking about a lot lately. When I look at what's happening across all these metals, I don't see isolated moves. I see a connected story. A story about money looking for safety. A story about distrust in traditional financial assets. A story about geopolitical uncertainty reshaping how capital flows around the world. Gold going up makes sense in that story. Silver going up makes sense. But copper going up, aluminum going up, nickel going up, that tells me the story is bigger than just precious metals. It tells me we're in a moment where real, tangible assets are being re-rated across the board, and that's a significant shift. Because it suggests this isn't just a gold trade or a silver trade, it's a real assets trade. And real assets trades can last a lot longer than people expect. Now, let me talk about something that doesn't get discussed enough. The dollar. The weakening US dollar explains some of the gains we're seeing in metals. When the dollar drops, it takes more dollars to buy the same amount of copper or aluminum or nickel, so prices in dollar terms go up, even if nothing else changes. But here's what's interesting. Prices in other major world currencies have also been surging. That's important because it tells you the move isn't just about dollar weakness. It's about genuine demand for metals. It's about investors around the world in euros and yen and pounds bidding up these assets. When prices rise only in dollars, you can chalk it up to currency effects. When prices rise in every currency, something more fundamental is happening. And that's what we're seeing. A global repricing of real assets that transcends any single currency. Let me give you some perspective on what this means practically. If you're holding metals right now, whether precious or industrial, you're benefiting from this repricing. Your assets are worth more in every currency. That's a genuine gain in purchasing power. But if you're thinking about getting in, you need to understand that some of these moves have already happened. You're not buying at the bottom. You're buying after significant rallies. Does that mean you've missed the boat? Not necessarily. It depends on where prices go from here, and that depends on whether the forces driving this rally continue. If dollar weakness continues, if uncertainty persists, if China keeps restricting exports, if speculative flows keep coming, then prices could go higher still. But if any of those factors reverse, if the dollar strengthens, If uncertainty fades, if China opens the export spigot, if speculators take profits, then prices could pull back sharply. That's the risk you need to weigh. Now I want to talk about something specific that caught my attention in the data. Nickel. Nickel is up almost 28% in a couple of months. That's a massive move. But here's the thing. Nickel is likely to remain in oversupply. Let that sink in. The supply exceeds the demand. There's more nickel available than the market needs, and yet the price is surging. How do you explain that? You explain it through speculation, through money flowing into the space regardless of fundamentals, through industrial metals catching a bid because everything else in the metals complex is rising. And that should give you pause, because when prices rise, despite oversupply, they're vulnerable. They're elevated on sentiment rather than substance, and sentiment can shift in a heartbeat. I'm not saying nickel is going to crash tomorrow. I'm saying you need to understand what you're buying. If you're buying nickel because you think demand exceeds supply, you're buying for the wrong reasons. If you're buying because you think speculative flows will continue, at least you understand the real driver. That kind of clarity is essential in a market like this. Let me shift gears and talk about something that ties all of this together, the Trump factor. Love him or hate him, Trump's policies are having a measurable impact on commodity markets. The uncertainty around tariffs has been driving flows into real assets. The fear of trade wars has been reshaping supply chains. The unpredictability of his announcements has been keeping everyone on edge. And that uncertainty is bullish for metals. Think about it from an investor's perspective. You don't know what's coming next. You don't know if tariffs will hit tomorrow or next month or never. You don't know how trade partners will retaliate. You don't know how supply chains will be disrupted. In that environment, holding paper assets feels risky. Holding things you can touch feels safer. Metals become a hedge against policy chaos. That's partly why we've seen this broad-based rally across all metals. It's not just about gold. It's about the entire complex benefiting from a desire to own real things in an uncertain world. The copper tariff situation is a perfect example. Traders were so worried about potential tariffs that they front-ran the policy by shipping copper into the U.S. before any duties kicked in. That created its own supply shock. And even after tariffs were imposed only on some products, the elevated prices stuck. Policy uncertainty created market dynamics that drove prices higher, regardless of underlying supply and demand. That's the world we're living in right now. And if you want to understand commodity prices, you have to understand that policy is now a first-order driver. All right, let me step back and give you the bigger picture. We're in a moment where multiple forces are converging to push metals higher across the board. China is tightening supply through reduced exports and domestic prioritization. The dollar is weakening, making commodities cheaper for foreign buyers. Policy uncertainty under Trump is driving demand for real assets. Speculative flows are pouring into metals because gold and silver are trending, and industrial metals are along for the ride. And underlying all of it is a growing sense that paper assets might not be as safe as they used to be, that governments have borrowed too much, that currencies are being debased, that the old rules might be changing. When you put all of that together, you get what we're seeing, a broad-based repricing of real assets that goes beyond gold and silver. The question is whether this continues, and how to position yourself accordingly. Here's my honest take. I think there's more runway in this trade, not because fundamentals are screaming for higher prices, but because the forces driving this rally don't seem to be going away anytime soon. Dollar weakness looks likely to continue if the Fed eventually cuts rates. Policy uncertainty isn't going anywhere under Trump. China's export restrictions are structural, not temporary, and speculative money tends to follow trends. All of that suggests metals could go higher still. But I also think you need to be realistic about what you're buying. You're not buying a sure thing. You're buying an asset class that's being driven by a mix of fundamentals and speculation. And speculation can unwind quickly. So here's what I would suggest. Don't chase prices blindly. Don't FOMO into positions at all-time highs just because the chart looks exciting. Understand what's driving the move and decide if you think those drivers will continue. If you're going to get exposure to industrial metals, understand that you're playing a different game than precious metals. Industrial metals are more tied to economic activity. If the global economy weakens, demand for copper and aluminum and nickel drops. That's a risk you need to account for. Think about your time horizon. Are you trading or investing? If you're trading, you need to be nimble. You need to be ready to take profits and cut losses quickly. If you're investing for the long term, you need to be able to ride out volatility without panicking. And most importantly, understand that nobody knows how this ends. The smartest analysts in the world are looking at these moves and admitting the fundamentals don't fully explain them. That humility should inform your own approach. Now let me share something personal. When I first started paying attention to industrial metals, I was bored. Copper didn't excite me. Aluminum felt like something you wrapped leftovers in, not something you invested in. Nickel was just a coin. But over time, I came to appreciate something important. Industrial metals are the backbone of the real economy. Every building, every car, every piece of infrastructure, every electronic device depends on these metals. They're not glamorous, but they're essential. And when you understand that, you start to see them differently. You start to see them as barometers of economic activity, as signals of what's happening beneath the surface. Right now, those barometers are telling us something. They're telling us that money is flowing into real assets across the board. They're telling us that uncertainty is high and people are seeking safety. They're telling us that the old correlations and fundamentals might not apply the way they used to. Whether you act on that information is up to you, but at least now you have it. Let me talk about one more thing before I wrap up. The relationship between precious metals and industrial metals. In normal times, these two categories behave differently. Precious metals are driven by fear and monetary dynamics. Industrial metals are driven by economic growth and manufacturing demand. They often move in opposite directions. But right now, they're moving together. Gold up, silver up, copper up, aluminum up, nickel up. That's unusual, and it suggests something important. It suggests the move isn't just about fear. It's not just about safe haven demand. It's about a broader desire to own real things in an uncertain world. When precious metals and industrial metals move together, it's usually a sign of distrust in the financial system, a sign that investors are looking for alternatives to paper assets, a sign that something fundamental has shifted in how people think about money and value. That's the signal I'm taking from this rally, and it's a signal worth paying attention to. Now, I want to address the skeptics. Some of you might be thinking this is all overblown, that prices will correct, that fundamentals will reassert themselves, that the speculation will burn out and we'll go back to normal. And you might be right. Markets do correct. Speculation does burn out. Fundamentals do matter over the long term. But here's what I'd say to that. Even if prices correct from here, even if we see pullbacks in copper and aluminum and nickel, the underlying forces driving this move aren't going away. Dollar weakness is structural, tied to massive fiscal deficits and monetary policy. China's export restrictions reflect strategic priorities, not temporary policies. Geopolitical uncertainty is the new normal in a multipolar world. Distrust in paper assets is growing, not shrinking. So even if the short term is volatile, even if you see pullbacks and corrections, the longer term trend might still be higher. And positioning yourself for that trend requires understanding what's really happening. All right, let me give you the summary for those who just joined or need a quick recap. Industrial metals like copper, aluminum, and nickel are surging alongside gold and silver. Copper is up 24% to record highs. Aluminum is up 16% to the highest level since 2022. Nickel is up almost 28% to a 21-month peak. The fundamentals don't fully explain these moves. Copper and aluminum are roughly balanced markets. Nickel is oversupplied, so something else is driving prices. That something else is a combination of Chinese supply dynamics, including reduced exports and new licensing rules, a weakening dollar, policy uncertainty under Trump, and speculative flows following the precious metals rally. Industrial metals are riding the coattails of gold and silver. Money is flowing into real assets across the board as investors seek alternatives to paper assets in an uncertain world. The big question is whether this continues. The forces driving the rally don't seem to be going away, but speculation can reverse quickly. Position yourself accordingly. That's the story. That's what's happening behind the headlines while everyone's focused on gold and silver. Now here's what I want you to think about as you go about your day. The market is sending signals. Gold is a signal. Silver is a signal. But copper is also a signal. Aluminum is also a signal. Nickel is also a signal. When all of them move together, when the entire metals complex catches a bid, it's telling you something about the world. It's telling you something about how investors are feeling. It's telling you something about where money wants to go. Pay attention to those signals. Don't just focus on the obvious trades. Look at the whole picture. Because the whole picture often tells a more complete story than any single asset. That's what I try to do on this channel. Give you the bigger picture, help you see what others might be missing, and hopefully help you make better decisions with your own money. Thanks for watching. If you found this valuable, leave a comment and let me know what you think about industrial metals. Are you paying attention to copper and aluminum? Or are you focused only on gold and silver? I'm curious to hear your perspective. I'll see you in the next video. One more thing before you go. Everything I share here is for education and entertainment only. I'm not a financial advisor. I'm just a guy who spends way too much time thinking about markets. Do your own research. Consult professionals if you need advice. And never invest more than you can afford to lose. This is Mr. AG Asian Guy. Stay curious, stay humble, and I'll talk to you soon.